All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by our senior markets correspondent, Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. Long week here. It's thundering.
I can hear it.
Yeah. How you doing?
I'm doing well. So first things first, Bob, I know you were just in Europe. You took a trip to Italy. So I was wondering if we could start there. Tell us about your trip and what you kind of saw with the tourism industry there.
Well, I've been going to Italy for 50 years, and it's my favorite country to go to, Italy and Spain, and it doesn't disappoint. The greatest export that Italy has is actually not a thing. It's an idea. It's La Dolce Vita, the sweet life. It's this sort of combination of an attitude about life. It's pleasant people to be around. It's amazing wine. It's amazing history. It's astonishing food. That's the whole thing, La Dolce Vita, that Fellini made famous 50 years ago in so many movies. Fast cars and things like that. And I'm to tell you, La Dolce Vita is alive and well in Italy. I went to Rome and to Venice, but I went to a new place. I went to Emilia-Romagna, which is a region in the center, about an hour and a half south of Venice. That's sort of the foodie capital of Europe right now. So there's a series of towns there, Parma, where they make Parmesan, Modena, where the Ferrari factory is, and Bologna is the big city, famous university city place. And then there's Rimini on the Adriatic, which is sort of like the Jersey Shore. It's a big shore town for like 40 miles, just and place where Italians go and just vacation and party essentially. So all that's still there. It's a really good deal for Americans right now. It's $1.07 to the euro, as I recall, and that's a good deal. You can get a great plate of pasta for $11. You get an amazing bottle of wine for $20. You get nice meat for $20, $25. But the downside is La Dolce Vita is alive and well for tourists going there. For the Italians, it's a little tougher. They're having a tough time of it. The Italian economy is stagnant. GDP growth it's not really growing. Wages are kind of flat. There's been 8% inflation. So I'll give you an example. I was with somebody in Rimini who manages a restaurant. And he said, so my employees here, the waitresses, they make 25 to 30,000 euros, which is sort of $25 to $30,000 a year. Okay. He said, the taxes are very high. If they pay all their taxes, they'll pay almost half of their income. That's a lot. You want to get an apartment here? You're a young person, a tiny one bedroom, 600 euros a month. I mean, like the size of a piano. Excuse me. That's about 40% of your take-home pay if you pay all your taxes. So he kept saying, if you pay your taxes. I said, well, what happens? Do people pay all their taxes? He said, there's an enormous gray market here. A gray market is an economy that's not illegal, but people get paid under the table or they avoid their taxes and things like that. And that's kind of what you have to do to survive. So they need more job growth. My opinion is they need lower taxes. They need to make it easier to start a business. It's not easy to do right now. And that's the downside of the whole thing. La Dolce Vita, alive and well, but the Italians are having some problems fulfilling that dream. I would encourage anybody to go to Italy, though. They're just wonderful people overall.
Yeah, I think all of us watching are very jealous of your trip. So it sounds wonderful, Bob. Now,
I wrote about it, by the way, Katie. If you want a little bit more, you just go online and type in my name and type in Bologna or something like that. I wrote a story, sort of highlight a few days ago. You can pull it up on my Trader Talk.
Yeah, I would definitely recommend. Yeah, if you go to CNBC.com, you can find all of Bob's Trader Talks and his articles on there.
Yeah, tradertalk.cnbc.com.
Tradertalk.cnbc.com. So definitely check it out if you want more. And so let's switch to stocks now, Bob. What's been driving stocks higher recently?
Well, we've had an amazing week. What are we up 3% this week? We are, dramatically 6% for the month, 15% for the year, something like that. What's really driving things is the soft landing, which is winning the argument. So what's a soft landing? Soft landing for the economy? It means employment would remain relatively strong. It'll weaken a little, but it'll still be strong. Earnings are going to hold up. Interest rates are going to top out, and we'll avoid a serious recession. There'll be a slowdown, but there won't be a serious recession. That's the soft landing. The problem is a lot of people still don't believe it's going to happen. Why? Because every time historically the Federal Reserve has come in to try to tamp down inflation, they have dramatically raised interest rates. Why? Because that's the only thing they can do. They don't have there's no fine instrument they can use to slow the economy down other than increase interest rates, which will slow demand, which lowers inflation. It's that simple. Historically, when you had this kind of inflation, the Fed has stepped in, aggressively raised rates, and yes, they can stop inflation if they do it enough, but they usually create a recession. So everybody knows this, and it usually creates a decline in the stock market because earnings decline, and earnings are what matters. So you get earnings recession too. So everybody knows this. This is a very well-studied phenomenon. It go back 100 years. So last year, everybody said, oh boy, we're in trouble because the Fed's going to raise rates aggressively and they're going to cause a recession. And that's why the stock market dropped 20% last year. Remember, we bottomed last year was it October? Yes, October. And so everybody was convinced the earnings were going to fall apart. But guess what? It didn't happen. The earnings did not fall apart. In fact, they've held up. We're about even with last year on the earnings. And in a recession, earnings can drop 10, 15, 20, 25%, somewhere around that. Hasn't happened. The market dropped, prices dropped, but they've rebounded. We're back at a 52-week high. We're not at an all-time high, but we're at a 52-week high. Okay, so everybody's been wrong. And wouldn't it be something if actually the Federal Reserve got it right this time? It would be unusual, frankly. But so far, it's been happening. A lot of this may have to do with the very unusual circumstances around COVID. It just created a lot of money and rebound jobs that are out there. A lot of people have money, didn't go back to work or don't want to go back to work or looking for better jobs. This creates a lot of dynamism and movement in the economy. Whatever. What's driving stocks right now is the fact that the soft landing seems very intact. And everybody who predicted we're going to get this big recession and earnings are going to fall apart, so far, they've been wrong. Even when we had a banking crisis in March and April. Now, remember, Powell this week, Jay Powell, the head of the Federal Reserve, came out and said, we're going to probably raise interest rates once or twice again. Now, we've already had 500 basis points of increase, 5 percentage points. That's a lot. So they're talking about another 50. That's only 10% more. So, and the market didn't drop. So what does this tell you? It tells you that the market believes that it can stand another 50 basis points in hikes, another 0.5%, and that the economy is strong enough to handle it, or they don't believe Powell. They don't think he's going to do it. Regardless, the market's not down on this. So this is really a sign right now. I'm coming up, with the market this high, what you want to do is look for reasons why the market would drop. What supporting reasons would you give it? And right now, with earnings holding up, no signs of a recession, the job market's still relatively strong. It's hard to make an imminent case that we're going to have a dramatic drop in the stock market in the next few months. Now, some black swan event could occur, like the banking crisis, that will mess things up. We probably will have some kind of downdraft if everything goes normal in the summer, we'll drop at 5% or something like that. But that's statistically normal. I'm talking about something where, the S&P goes back to zero on the year. Remember, we're up almost like 15%. What event would cause that right now? Gee, I don't know. It would take a lot to do that. That'd be a big drop. So, the soft landing so far is right. And it just goes to show you, the crowd last year, everybody thought there was going to be a recession. What does this tell you? People are usually wrong. People have terrible track records at predicting the future. I wrote a whole, Katie and I, you've talked about the book I wrote, Shut Up and Keep Talking. There's several chapters devoted to the fact, trying to explain how stock prognosticators are so wrong. They They get it wrong all the time. Even the Federal Reserve. Jay Powell admitted this week that the Federal Reserve's forecast on predicting inflation was terrible. He admitted it. Not only is it bad on inflation, it's bad on predicting the economy. They have a terrible record predicting the GDP just 1 year from now. Everybody does. You'd think with the best economists on earth, the Federal Reserve would have a better handle on things. They know more than we do. They don't. Now, what does this tell you? I mean, you throw up your hands and say everybody's an idiot. I would be a little less cynical than that. Everybody's making an honest effort. People aren't morons. They're not stupid. But they're just wrong. Why? And again, those of you who really want to know, look into this, there's several chapters in the book about why people are consistently wrong. There's two major problems. One is that there are biases that infect our thinking, behavioral biases, biases in the way we think and reason and in the way we feel. And behavioral economics is an entire field devoted to studying the biases that cause people's predictions to be wrong. The second reason that people can't predict the future very well is that it's very complicated. The number of variables that go into predicting the future. Think about the weather. Weather forecasting is pretty good 3-4 days out. You start going a week out, it gets terrible because the variables multiply. It's the same with anything. Even if something as simple as if you're the Caterpillar analyst, you're supposed to figure out what Caterpillar's earnings and stock price is going to be a year from now. It's just one stock. You think anybody could do it, right? Turns out to be really hard to do because even with Caterpillar, the variables that go into making up Caterpillar's earnings and stock price are tremendous. Includes the macro economy, the micro economy, and includes the leadership in Caterpillar. Something could happen to the leadership. They could make an acquisition that drops earnings. It turns out there's thousands and thousands of variables that just go into determining Caterpillar stock, and it's really hard to build a model that would figure that out. So this is a simple way of saying, this is why Jack Bogle became famous. You stay long. You don't try to make crazy predictions because the evidence is that despite all this goodwill, knowledge, information, and entire careers devoted to figuring out what the future is going to look like, nobody's very good at it. The only thing we know is that based on historical precedent, and I'm just talking about the stock market tends to rise over time. That's a fact. And unless you think somehow this is going to change on a long-term basis, and I will not make that bet, that's why you stay long. That's exactly it. I know I detoured a little bit here, but it's very important for people to understand how little we can actually know about the future and how hard it is to, for example, pick stocks and why you don't want to do market timing. It doesn't work.
Yeah, for sure. And that kind of speaks to another question that we got this week, Bob. You know, is it time to exit or will stocks keep rallying? And it speaks to your point, you know, it's hard to
Right. Right. So forget about trying to exit. So I know everybody thinks like, okay, now this is going to be it. I'm going to get out of the stock market, sell everything, and then I'll get back in some date in the future that I don't know when it is, when I feel like it, when my bunion starts hurting again. I'm going to make this very simple for people who think, you know what you're doing. You don't. If you look at this, and this is again in the book, and there's endless studies about this. In any given year, there's 6, 7, 8, 9, 10 days that matter, where a lot of the gains actually happen. If you're not in the stock market on those 10 days, your returns are dramatically different, dramatically lower. Here's the problem. Nobody knows what those 10 days are. Therefore, you must stay in the market. And you can do this on the other side too, by the way. Nobody knows what the 10 worst days are either. This is why you just stay long. And you can slice and dice this endlessly. I mean, literally, you could look back 50 years, and if you're not in the market on the 10 best days, your returns are dramatically different. We can't put the numbers up here, but these studies have been done. And you have no idea what those 10 best days are going to be. Nobody does, not the Federal Reserve, nobody does. So this is why you actually, stay long, why people who call and say, well, this is it. Shouldn't I just get out of the market? I said, I don't know how you have this certainty, but nobody I know has a track record that would indicate that I would follow them on that line of thinking.
And if you're, 40, 50 years old, you are still going to want to be in the market for another 40 plus years, right?
Yes. And I I am one of the few people that has actually written a book where I tell people what I own. And it's not very complicated. You put it on an index card. The single largest holding I have is an S&P 500 index fund. And I am in my late 60s, and 75% of my more than 75% is in stocks. So, you know, I'm planning to live till 90. Okay. Let's say I'm 70. I'm almost 70. That's 20 years. So if last year we were down 20%, and it's a blip. If you start looking at it over 20 years, it doesn't matter. I know it sounds like a lot, 20 years. And if you're just doing it, you're going to buy and sell in 1 year. That's a lot. But in the course of time, it's a blip. It doesn't mean anything. So that's why I did nothing last year. I put a little money into 1 year Treasury ETF because there's no reason to stay in cash when you can get 4%, essentially risk-free. So there's a little bit of position in cash. You always keep 3, 4, 5% in cash. There was no reason to do that. Other than that, I haven't done anything in a number of years. And it's in the book if you want to read it.
Yeah, for sure. Well, Bob, yesterday was a really big day at the stock exchange. We had Cava's IPO. So can you tell us a little bit about what it was like to be on the floor yesterday?
It was like the old days. I've been on the floor since the 96, 97. I have participated in probably thousands of IPOs. And again, this is in the book. It's my favorite thing to do. It's literally my favorite thing. Because here's what happens. The company like Cava goes public, and they bring in 200 people. It's some of the top management, but it's also just like employees at the restaurants, probably 250 people. And it's the biggest day of their life. They're coming into New York Stock. They get in at 7 a.m. They bring them upstairs. The boardrooms, magnificent gold leaf boardroom, 60-foot high ceilings. And welcome to the New York Stock Exchange and capitalist system. They have breakfast, and then they go down on the floor. The CEO rings the opening bell. And I talked to the CEO. We had him on the air. I met the CEO's mom and dad. It's a big day. You bring your family. It's like the top of your career. And they're all standing around waiting to go public, and they're all staring, and, you know, it takes a little while. And one of the things I joke about is all these people are staring at the screen looking at the indications. So the stock, Cava, priced at $22, but they put up indications about where the interest is, you know, the bid and ask. So 32 to 33, 34 to $35, and eventually it opened at $42, which is a huge jump. Priced at 22, opens at 42. So that's big. So in between, people are just staring at it. And one of the things that it's always funny, you can see people doing is they're calculating their net worth. They're saying, okay, let's see, it's $32 right now. If it opens at $32, I have 10,000 shares or something like that. You can just see they're doing like calculations in their head. It's sort of capitalism at its best. But the fun part is just meeting the families, because I'm standing there reporting. I was on the floor for most of the morning, and it's a big thing just to meet everybody. So this hasn't happened in a while because the IPO business has been an enormous drought for 18 months. There just hasn't been any business. So I'm hopeful that this will be the start. There are tons of companies waiting to go public. Reddit, for example, or Fogo de Chao, or ARM, which is the big chip designer that's out there. I put up a dozen companies yesterday. So I hope that this will be the start of something. Why am I hopeful? Because in my experience doing this for 27 years, or 26 years, or whatever it is, the three things matter in the IPO market. Number one is you have to have a strong market. Well, the S&P is at a new high. That's a strong market, right? You have to have sort of stable rates. They're stable. I don't think people are expecting gigantic moves up in interest rates at this point. And it really helps to have rising valuations. So it entices the people who are out there wanting to go public, saying, we could get a higher price than we thought for our company. Well, hell, when you get Cava up 100% on the first day, that's as much enticement as you can get for an IPO company that's out there waiting to go public. So you have the three conditions that are necessary all satisfied. Well, this is it. I mean, if we don't, unless the market collapses, if we don't see a lot of interest from companies saying, okay, I think we're going public, in the next 2 months, something's wrong, Katie. Normally, this should be the right market. This should be the time we should start hearing. And it's one of the things I'm really looking forward to, frankly. A lot of these companies, they're already middle-aged. In the 1990s and the 2000s, companies went public relatively young. Now these companies have been sitting around for years because they have low interest rates. They've got private equity feeding them money. That's got to change.
So, Bob, our next question is kind of about your experience working for CNBC and at the New York Stock Exchange. What has changed the most, and what hasn't really changed over the time that you've been working here?
What's changed is technology. When I got on the floor, it was 1997, and there were 4,000 people on the floor. And the trading on the floor was 80% of all the volume in the New York Stock Exchange. 80% took place on the floor. 4,000 people yelling and screaming. It was what we call mostly open outcry. There was some electronic trading, but it was mostly open outcry. Brokers yelling to market makers. And today, there is 225 people that do 15 to 20% of the volume. Think about that. 4,000 people in 1997 to maybe 225 people. That is technological disruption. And what happened there was electronic trading. The technology evolved by the 1990s to match the hardware and the software evolved to be able to match buy and sell orders electronically in sub-second intervals. That turned out to be more efficient than floor trading. And we also had a reduction in the bid-ask spread. So when I got there, it was in 1996, they were trading in eighths, 12.5-cent increments. Imagine that. And it's a profitable business when the minimum you can get per share is an eighth. Then they went to 16ths in 1997, 6 1/4, and now it's pennies. The spread is a penny now. So the profitability of the industry declined dramatically. And that forced a lot of people out of the business. But technology is the big thing. I'll tell you what has not changed. People. Fear and greed. Think all the emotions, love, lust, hate, fear, greed, all of that things. The things that motivate men and women have not changed since the days of the Roman Empire, since Caesar. And that's why I look at people and they think things are different. And I say, this is not different. The way you think is not changed. You can have all the change you want, but most people refer to this as technological change, what I was just telling you about. That's not mental changes. You can have all the technological change you want, but unless your brain changes, unless your thinking changes, what happens is people make the same mistakes over and over again. And that's why I keep talking about behavioral economics, about the biases people have. These biases have always been there. They haven't changed just because you're using technology. Now you have a faster way to apply your biases, essentially. You see? So recognize how different the world is. Yes, this thing is amazing, this iPhone, but also recognize how little has changed. Look at yourself. And I'm going to tell you right now, you go read some of the writings of the ancients 2,000 years ago. The stuff they talk about, the emotions they have, the competition, the jealousies, the hatred, the fear, the greed, it's all there, and it's all still here today. So that makes you, at least it makes me very humble. I know what technology is, but I also know how little we've changed. And the only thing I've gotten better at is recognizing that. I've gotten wiser, more understanding of those biases, including my own.
Yeah, I think that's something we can all do, is just be a little bit more aware of all of those biases. So, Bob, our last question for today is, what is a market maker? You kind of explain that a little bit.
Yeah, a market maker is anybody who makes a market in things. I mean, think about something. You want to buy something, okay? Suppose you want to buy coins. I collect rock posters. You see these rock posters behind me. I could find somebody if I want to buy a poster, a Jimi Hendrix poster. I could find somebody who I think might have one and offer him something, but probably when you're dealing with collectibles like rock posters or vinyl albums or coins or anything, stamps, you usually have a broker, somebody who actually specializes in having this, and they connect buyers and sellers. And what do? They charge a fee, a brokerage fee. This exists in the stock market too. There are brokers that are out there. On the floor of the New York Stock Exchange, there are they used to be called specialists. Today they're called designated market makers. The way this evolved was 200 years ago, the New York Stock Exchange was founded in 1792. Originally, in the early days of trading, there was not the way we have it today, continuous trading. They traded one stock at a time, believe it or not, and they usually traded it in 5-minute intervals. So the chairman of the New York Stock Exchange would say, okay, today we're going to trade a railroad stock, pick it, Union Pacific, or something like that. And we'll trade it 5 minutes. I have a bid of $10. Who will give me $10.10? And literally, they had an auction for one stock, and then they moved on 5 minutes later to another stock. In the 1860s, they went to continuous trading, where there was a floor that opened next to the old NYSE, and people stood there and traded stocks continuously. All the stocks that were listed on the New York Stock Exchange, not just one at a time, all. And what happened very quickly was it was so complicated even then that individual brokers started specializing in individual stocks. So, for example, if you had a water company or a railroad, you'd say Bob Pisani is, I have a lot of that stock. And so I can act as a broker between buyers and sellers. And I specialized in, say, Union Pacific, for example, or something like that. And that's how the specialist system developed. Eventually, people just traded that one stock, and brokers around them would say, okay, I got a buyer. I need 100 shares of Union Pacific. What do you charge me? And he would charge price and a VIG, a brokerage commission. So today, there are still designated market makers on the floor that specialize in trading individual stocks. Most of them, because of electronic trading, trade very large numbers. Their panel, as it's called, will have 20, 30, 40 stocks on it. Now, in the old days, when I was there in the 1990s, if you had some guys who had a big stock like General Electric, that's all they traded all day long. That doesn't happen anymore. Electronic trading has made it possible for you to watch things very easily, and a lot of this trading just gets done automatically. But you have a specialist still. This is the difference between NASDAQ and NYSE, sitting there watching all of these stocks, his panels. He might have 20 stocks. He's sitting there watching them. And you can still see this on the floor of the New York Stock Exchange. You don't see brokers going up to the NYSE, to the designated market maker, saying verbally, I got 100,000 shares of Pfizer to buy or sell. What do you give me? What do you offer? Because they can do this electronically, standing in their booths and separately. So you don't necessarily see people shouting at each other anymore. But the designated market maker is still standing there looking at the stocks that they're in charge of, and they can manually intervene. They can go in and do trades. And a lot of these guys are very active at the open and at the close. So the concept of a market maker has changed very dramatically, but it's still very much alive.
Yeah, I think that's definitely helpful for people to understand. So thanks, Bob. And we did get a LinkedIn comment. You mentioned your posters behind you. We got someone on LinkedIn saying they love your posters and you should have them in a special exhibit. So another shout out.
Maybe at the New York Stock Exchange someday. This has become quite a business. The Museum of, as I recall, it's either the Museum of Modern Art or the Metropolitan Museum in New York had an exhibit of 60s rock posters. It's very eerie to walk into a museum and see. I own almost all the posters, and eerie to see them in a museum. So it's nice to see. It's nice to appreciate it.
Yes, certainly. Well, thanks, Bob. Thanks for answering all of our questions. Thank you to everyone who sent in questions. And we'll talk to you again soon. Good luck with
Thank
the
you, Katie.
thunderstorm.
Thank you, everybody. Take care.
Thank you. Bye.